Okay, so just a quickie on some of the issues I'm talking about. It might be argued that somebody might say, oh, banking doesn't work anything like that before. I have an A level in economics. I have a degree, a PhD, a master's in economics, and we were taught in university that the banking system works on something called fractional reserve banking. It's kind of really weird. It's quite an amazing thing, this, that no, it doesn't. The London School of Economics is talking nonsense and has done for centuries. I don't know how long have the thing's been open, 1917. Fractional reserve banking doesn't exist. The idea that it's some naff little story whereby somebody goes into a bank and puts £100 into the bank. They don't say where that money comes from, and they seem to be thinking it's notes and coins, I think, somehow or other, and that's the basis of the economy. And then, having got £100, the bank then, because of some fractional reserve ratio, then lend out £80, and that £80 ends in some other bank, and then that bank can lend 80% of that £80, a bit like, and hence the economy goes round. One aspect of that being utter nonsense is they never give the story of when the first person walks into the bank and takes his £100 back out, and then there's a whole chain of the banks rushing round to recall in loans and overdrafts every time somebody takes a cash out of the bank. It's a ridiculously unstable story. Makes no sense at all. And as you can see here, that the Bank of England had to issue a report to say they're talking absolute nonsense, and always have been. But still, fractional reserve banking is taught as something that exists, and the academic world and the real world is shown very starkly here to be on different pages, and the academic world is just flat wrong, 100% wrong. It's not the only part of the world where the academic world is wrong. It's very difficult, having tried it myself, to discuss this on places like Wikipedia. Any entry you make, or any entry I made, was instantly deleted because it wasn't referenced from an academic source. And apparently they have these rules that say it has to be a proper source, which is an academic source, but the academic source is all nonsense. Some academic made up what might be a good idea, and they sort of ran with it. All over the academic world, nonsense like this. All over the rest of the world, where you say that's nonsense, you are banned and deleted because an academic has said something different. But it's a very stark example of this. So yes, so fractional reserve banking, utter nonsense, is still taught in textbooks, and I think it was 2015 or something like this, 17, the Bank of England just said, what are you talking about? So there is a little bit of fractional reserve, but it's not the basis of it. What happens is a little reserve, a very small reserve, is demanded by the Bank of England for some very small percentage of the outstanding loans that you have. And a bank will just go and buy that little small reserve from the Bank of England, and they kind of do it on something like a 3-week rolling basis. Basically, they take an average, and up to very recently, that meant that essentially the Bank of England was holding some loan that was earning some interest for it, and the commercial bank who bought it was holding a reserve from the Bank of England in replacement of this, a very small amount, and that was not paying any interest. And the Bank of England used that as their income source. It's like an administrative fee, basically, and in proportion to the size of the banks. The Bank of England was only ever the size up until the financial crisis, when they started buying lots of bonds and became a completely different creature to what they had been. They were about the size of Birmingham Midshire's building society. They were sort of a small building society. They weren't the basis of the economy by any stretch of the imagination. So so if you think what I'm saying is wrong here, and your reason for thinking that is because the academics have told you something different, the academics are 100% talking sausages. The other thing I'd like to point out is that when somebody if you get a mortgage company, your Bradford and Bingleys, and that Leeds Building Society, when they issue a mortgage, let's say call this building SOC. When they issue a mortgage, they don't actually do the mortgage directly, as I was kind of indicating before. They don't say, I will take on a mortgage here and have the mortgage, I don't know, £200,000, and I will give you a cash of £200,000, and then you pay interest on that for the rest of 25 years or whatever. They don't actually do that because that's sort of a little bit unstable, really. To have £200,000 in with one client is a bit too much of a high risk for them. If they can't pay and that £200,000 gets written off, then the whole building society takes a really big hit. What they actually do is, the building society goes to the market and they say, listen, we are going to issue a whole pile of mortgages over the next year, and we need a fund for that, so please buy our fund. So what they do is they say, well, they issue a bond. So you got the building society, and this is their balance sheet, BSBS, building society balance sheet, and they say, okay, let's do, £50 million, and they get in £50 million of cash from selling a bond, and they have a bond, they have a liability of £50 million, and on this bond they pay, sometimes I think once I saw 8%. I don't think they do that anymore, to the people who held bought that bond, and they have the £50 million in cash, and they give that £50 million in cash out to various people who are buying the house, and so this cash very quickly turns into a mortgage, which with a bit of luck will pay 9% or over 8% would be the hope, and their income would be the difference between them. That was the sort of business model. Now the point, where did they get this? Who did they sell that £50 million to? Well, they went to the market, i.e. they just said, anybody want to buy it? And where individuals bought it, an individual who'd have £1,000 in their bank, if they bought £1,000 of this bond, they would then have £1,000 less in their bond, in their bank, than they did before, and that would then arrive as the cash for the building society, and then the building society would give that to the mortgage holder, the person buying the property. The person who bought the property would give it to the person who's they're buying the house from, and that person would then have that £1,000. So there'd be £1,000 down from this person, and it would end up eventually as £1,000 up for the person who sold the house at the end of the chain type thing. There would be no difference in the amount of money knocking around in the country. The £17 wouldn't appear on that basis. But a lot of people, a lot of private investors, individual people who had a few extra quid in the bank, just sitting there not earning interest, these were quite nice little bonds, and so they good way to save, and so they bought. A lot of them went to individual savers. It made no difference at all. So basically borrowed from savers, literally, to get the cash to give to the borrowers. But that didn't always happen. There wasn't a restriction that said only individuals can buy this, and foreigners would buy this, which would then mean an extra. The foreigners might have lost £1,000 out of their bank in their country, but there'd be an extra £1,000 worth if a foreign person or company or bank, whatever, bought this, or a company, investment firm, or whatever it is. And the other thing is, if a British bank ended up buying some of this bond, then when they bought the bond, they would say, okay, that would say that they bought £1,000 worth of the bond. They would have given what would be like an interbank loan, basically, to the building society. There'll be a liability here, and then that liability would end up as cash here, and that would be an extra £1,000 cash. So it wasn't an entire, every single penny of a mortgage went into being the £17 that we've been looking at, the extra profit, but different proportions of it did. I don't quite know what the individual percentages were, but overall, if you look at the increase in the money supply during the mortgage boom years in the 80s, 90s and early 2000s, then that extra money's come from somewhere, and it's come from foreigners. Maybe the Chinese bought it all, I don't know. But the British banks also would actually buy these bonds as well, or would end up, the transaction gets moved here, there, and everywhere, and repackaged as something else. They'll end up with that as an asset on their balance sheet, and hence the cash side of that would actually be new money created. So yeah, not entirely, but substantial amount was not taken from savers. It was new money created, as it were, by the banking system. The other aspect I just want to look at before we go into my solution, proposed solution, is when we were looking at fixed assets before, and every month he had the extra 17 quid. The guy had his, like a new warehouse or a new road or a new building or a new machine. The capital assets were building up £17 by £17 per month that fueled the funding of the profit. The thing is that the first time they do that, every week there would also be a depreciation charge, which would decrease the profit, because what they built on Monday wouldn't be worth as much on Tuesday, because things were down. At the beginning, it doesn't seem like a lot, but 17 quid, and the next week there was this 17 quid would continue. Let's say, for instance, they wrote it off. I'm going to do 17 weeks, but we can think of these in terms of periods. In 17 weeks, the depreciation charge would take that down to zero. In reality, 2 years, 5 years, some buildings would tend to be 10 years and 20 years. Some buildings get amortised, where they revalue them, and so that's another issue aside. The reverse of this in some ways, when the value of the building goes up, but generally looking at the stuff getting worn down, especially in the Industrial Revolution, lots of machinery was made. So in the first week there was £1 depreciation charge. And the next week when he bought another machine with the 17 quid he has spare, that would start to depreciate, and there'd be a depreciation charge of 2, and then 3, and then 4, and after 17 weeks, basically every week the depreciation charge would be, and when it got out to 0, there was no more depreciation. After 17 weeks, the depreciation charge would eat up the profit, and your profit would be 0. When the profit's 0, the companies don't tend to build stuff. So the fixed asset thing I was saying earlier on, it actually really only worked when they did 17 on the first week. The next week they built more, 18, and the next week they bought more, 19, and then more 20. So it actually wasn't just even fixed assets, but it was an ever-increasing amount of fixed assets in order the accumulated depreciation charge didn't wipe out all their profits. So there's an aspect of that going on as well. So it would be worse than you'd otherwise thought. So just want to add on those 2 points before we get on to the main event, which was my suggested approach to solving this problem.